Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all. Real estate experiment, what's happening, y'all? Today we have Steve Pollack. Did I get that right?
100% you did. That's perfect.
Fantastic. And you are the current CEO of Anchor Loans. And I didn't realize how dominant you guys were in this space. I was looking into it. You guys have been in business for plus 20 years, more than over 7 billion amount of loan volume that you've given out to folks. So you're helping individuals, you're helping communities, and then obviously more than 20,000, more than 22,000 from what your site says. I don't know if that's currently accurate. I'm sure as it's ongoing, and you're essentially helping investors and building communities. So I want to hear a little bit more about what you do, but more importantly, what I love having is when you come into the lab, Steve, is we get to find out who the person behind the business is. And we're really big on that, as far as I always say that the person behind the business really reflects how their business executes. So first of all, Steve, why don't you give us a little bit of background about, how you got into what practice you are today, because I do believe you have a very different background, which I think is fascinating, and tell us where you are today and what your team does.
Sure, absolutely. Thank you for the opportunity for being here. This is great.
Of course.
So yes, 21 years. Anchor Loans have been around since 1998, making loans to investors like yourself who are investing in their communities by buying houses that need to be refurbished, remodeled, repaired, rehabbed, fix them up, sell them out to an end user, and so forth. I'll give you the 5-cent tour to my background. This is actually my fourth career. I actually went to school at UCLA, graduate school at UC Berkeley. I actually went to graduate school to be an eye doctor, and I was an optometrist for 10 years. Had my own practice. I've always been very, very entrepreneurial. When I was growing up, I had the typical little kid businesses that you have, lemonade stands, shoveling snow, mowing lawns, raking leaves, anything I could do to make a buck. I always was working for myself. So I knew when I eventually grew up, I want to do something to work for myself. I went to school, became an eye doctor, started my own practice, cold, right out of school, built it up, took on a partner, had a very, very thriving practice. But I realized after 10 years, that isn't something that I wanted to do for the rest of my life. So I actually sold my practice to my partner. So that was my career number one. Career number two was, while I was an optometrist, I was buying rental properties. So that's how I started in real estate. I actually bought rental properties before I owned my own house. I was living in an apartment, buying rental properties. So again, that's my assessment in terms of the path to wealth is to invest in wealth creating activities as opposed to investing in yourself, which is what I did. So I started by buying some duplexes and triplexes and so forth while I was an optometrist. When I sold my practice, I got into real estate full time, both buying rental property as well as, it wasn't called flipping back then, it was called property rehab, as a rehabber, buying properties, fixing them and selling them. So I did that for a few years until the downturn of the early 90s came along, when it became very difficult to sell properties at that point in time. So I was still doing some real estate on the side, but it wasn't active enough in order to actually make a living for myself. I kind of stumbled into my third career, where I was a professional poker player.
No kidding.
So, yeah,
I did not know that.
I played Texas Hold'em for a living for 7 years and supported myself while I was doing my real estate activity as well. But I played Hold'em like it was a job.
You're watching this, Steve's got his poker face on.
Yeah, I got my poker face. I got to smile more.
That's fascinating. Okay.
Yeah, so I used to go into the poker rooms here in California, whether it was in Northern California or Southern California when it was legal at that time, still is, and would make a living playing cards. It was very interesting. It was obviously, I worked for myself. I can go in whatever I wanted to go in, but I had all the downsides that you would think would have, basically no vacation pay, no sick pay, no pension plan, and sometimes you go to work with a bunch of money in your pocket and you come home with no money in your pocket, right? So it was net positive for me, but it's a tough way to make an easy living, as they say. But I was, at that point in time, I was making money. I was also investing passively in real estate by investing in trust deeds. So I was making loans to people who were buying properties and then fixing and selling them. And that's where the opportunity to create Anchor Loans with myself and my two co-founders came along. We pooled our money. We saw an opportunity to create a business for doing exactly what we were doing as an investment. And we started with our own money and some friends and family money in 1998. And we grew it from there into where we are right now, having made, like you say, over $7.8 billion worth of loans life to date, 22,000 loans, currently manage a portfolio of about $1.2 billion. Last year was our fourth year in a row of over $1 billion worth of originations,
Wow.
making them one loan at a time. Our average loan to investors like yourself is typically $200,000-$300,000. So we do a lot of loans. We flip a lot of hamburgers, as I like to say.
I love it. All right. So this is great because this is a great segue to get into, what is it that you really offer to the folks out there, to the investors? Again, we talked about it in the lab. We actually recently had Evan Holiday, which is actually, he's in the development space, and he brought a lot of enlightenment to us because he was talking about the difference between the value add multifamily and then the construction side of things. And I correct me if I'm wrong, Steve, that you do have a new construction loans and at the same time fix and flips, or as what we know as hard money. Do you want to go a little bit about maybe how those two are a little bit different from one another and how you would offer that to the people?
Yes. So we do both of those.
Mm-hmm.
The fix and flip loans is our core business. That's what we've done all along.
Okay.
We do ground up construction, what we call infill construction, which is basically building a house in the middle of a developed community. Usually has a house built on one side and on another side, and it's either a small house that's going to be torn down and then rebuilt from the ground up, or it's vacant land, a lot, whatnot, and our borrower is going to build a house on that. We're not a lender that lends to large developments that are doing 4-phase, 300 model home type of development. That's not who we are. We deal with the smaller organizations than your NARs or your major home building construction organizations.
Okay.
And so we try to take care of our clients. Basically, our mission statement is we at Anchor here create success through opportunities by helping create and improve homes and communities.
That's
right.
beautiful.
So we're there for our clients. We want to be part of your team, right? Yes, we can supply you with capital and help you finance the project, but that's not all we're about. We oftentimes will build relationships with clients who need to understand how to work their business better. Help me value a property. Help me understand my title report. Help me understand if I'm buying right, if I'm selling right. How do I find an agent? We've written many blog posts on our article on our website for people just download all this information for free. Well, it's our belief that as the community that we service gets more educated, more knowledgeable, can make better decisions, everybody grows from that. And that's what we're about. And if we can provide value for you there in that way only, that's great. If we can provide value by also helping you finance some homes, that's great also. Yes, we're a hard money lender. And what does that mean? That means we have the money to lend to you. It's not a bank. We don't have to get senior credit approval. It's us. It's our organization. Now we have a fair amount of an organization here. We have 150 people who work for me. But it's a process. We try to make it as streamlined and as client friendly as possible. If you need help ordering insurance, we'll do it for you. If you need help reading your title report, we'll do it for you. If you need a quick closing. So if you're a buyer and you make an offer to a seller, I can close in 7 days. We can do that for you. We actually, one of our top clients, it's not normal for us to do this. We actually got a loan in 3 weeks ago on a Monday and closed it 5 hours later.
Wow.
That's our all-time record. that's not normal.
No, it's not. And as we know it,
we have the capability of doing that. If you absolutely need to do that or you're going to lose the deal, we're there for you.
So I like what I'm hearing, Steve, because what I'm hearing is the sense of community that you've been really big on. I know I've looked into your stuff, and again, I would employ anybody to go on Anchor Loans and check out some of the stuff you're doing, and specifically yourself being really hands-on in the community, which is why I reached out to you, which I think is fascinating. But I like the idea that you're here to help an investor for the long term, or in the people business. Do you want to talk a little bit of what that may look like for someone who has a lot of experience, or maybe someone who doesn't? What does someone need to present at Anchor Loans for you to actually help them help themselves? So let's talk about, for example, I know there's a lot of different folks you might be helping, but let's say if I want to work with you, what are some things I need to consider and as an investor, and maybe you can get into the asset-based lending part of it. Maybe that might make more sense, or wherever you want to go. Yep.
Right. So most of our underwriting, what we care about most is the asset itself, asset-based lending, right? Yes, we need to understand who our borrower is and their credit worthiness. It's not the same thing as your regular consumer loan.
That's right.
We're not going to do your mortgage verification and your employment verification. No, we just want to understand that you have enough cash reserves to be able to service the loan, to fix up the property if you're doing it out of your own pocket. And you want to make sure that you have a good credit score, that you basically take care of your debts, because we're going to be a debt if you're going to come work with us. And in regards to the asset, all you need to do is come to us with a property that you've tied up, and what the purchase price is, and some basic information. How much you think you're going to need to fix up that property, how much you think the property is going to be worth after you fix that up. Those are the basics to get started. We can quickly evaluate that and tell you if this is something that we can work together on or not. One of the things that I like to tout is the things that I'm proudest of is when we actually turn down loans. What I mean by that is we've had investors come to us saying, I'm going to buy a property for X and it's going to be worth Y after I fix it up. We do a little bit of our research and we say, Mr. Investor, it's not going to be worth Y. It's going to be worth less than Y. You're not going to be making any money on this deal. I strongly advise you either to A, go back and try to get a bang down, try to get a lower price on the buy side, right, so that you can make money, or pass on that deal because this isn't a great deal for you. I feel good about that because we've had many, many occasions like this when the borrower, which is not unusual, might say, I know what I'm doing. You don't know what you're doing. I'm going to buy this property anyway. And then 6 months later, they come back to me and say, I got another loan for you because you were right on that first loan. I shouldn't have bought that property. Right. I did, and I lost money. Now I believe you know what you're talking about. That's when I'm proud because we're like you said, long term is super important for us. We don't want your first loan. We want your 21st loan. Yeah.
Oh, that's well said.
We want you to be successful.
Yeah.
Right. And you're not going to be successful at loan number 21 if loan number 1 is no good.
Yeah. And I love how you said that, Steve, because, we always talk about there's so many people that are involved in that process that are on your team. And you definitely want your call it your lender to be on your side of the team, there to guide you and support you. And unfortunately, not every lender has that intention, because we can get a little granular about the points and the terms that you have. But one thing I also want to note, and I saw this in one of your articles, I thought it was fascinating, that back in 2008, you guys were actually very prudent in how you went about making loans when everyone else was, lending. Do you want to talk a little bit about that? How you were able to really just make sure you guys were able to survive that time and that period? As we know, as investors, that was a little bit of a kind of a uphill battle.
Sure. So prior to the financial downturn, our peak year was 2005. Up to 2005, we did our most amount of volume. We've been growing every single year. We grew in 2005. At that point in time, we weren't a national company. We were mostly a California-based company, mostly here in Los Angeles.
Yeah.
But we lending all across California. We were concerned in 2005 that was the third straight year here in California, 15% appreciation year over year over year, which is unheard of in the real estate industry, right? It's nice if you're buying and flipping and whatnot, but we all know looking back with 2020 hindsight, we all know what the reason was with the subprime crisis and so forth.
That's right. Yep.
I'm not going to sit here and tell you I was smart enough to predict the subprime crisis. I wasn't. I just knew there was something wrong. My partners knew there was something wrong. So what we did in 2006, even though we had more loan applications and more possible business in 2006, we did 15% fewer loans in 2006 because we thought that there was an issue with the real estate, that something was going to happen. Well, nothing happened in 2006. Oops, sorry about that. Nothing happened in 2006. So again, in 2007, we did 25% loans less than we did in 2006. So we basically scaled down. We were telling our clients, you should be careful of what you're buying. You shouldn't be buying land. The land's the first thing that goes 50% right off the top when you hit a recession. Mm-hmm. You shouldn't be buying some of these other properties in the outlying areas that are more susceptible to price decreases, to value decreases in a downturn. Some of our borrowers listened, some of them didn't. And that was the reason why basically through the financial crisis of 2008, 2009, that 18-month period of time when everybody thought the world might be ending, and most real estate funds were losing 30, 40, 50% of their assets under management. During that period of time, we broke even. And wow. It all had to do with the fact that we prepared ourselves in 06, 07, leading up to what was happening. Yep. So we're long-term thinkers. For both ourselves and our client, we want to be here for the next 20 years. We want our clients to be here for the next 20 years. I'm okay with losing business in the short term. Yeah. Because all I care about is this is an infinite game. I want to be here for the long term. I want my company to be here for the long term. Everybody that works here wants to be proud of who they're working for, the company they work for. They're all behind our mission statement of helping improve homes and communities. That's what we're about.
I love that. And again, it goes back to you guys scaling down and seeing it's having the eyes on the market and being able to really see and have the best interest for your, I like to call it partnership, not even customers. I call my customers partners because I think it shows you have skin in the game. And so I love that. It seemed like you had the best interest because you did, and you were able to actually scale down when the opposite was happening, I'm sure, for other companies. And yeah, I guess 100%. The rest is history, and that's why we're here today still talking. So good for you. That's really cool, Steve. I want to take a step back a little bit because in the beginning we touched on, the type of lending that you guys do. And obviously, when I say that, we specifically talked about hard money. But I want to go back a little bit about the new construction loans because that's something I'm not familiar with. And if I'm not familiar with it, I'm sure my community is not as familiar. And that's definitely not my area of expertise, and because we have you here, want to take a little bit advantage. What does that really mean? Because I saw I'm familiar with loan to value. I saw loan to cost on your website. Do you want to talk about that process at a high level, just so we understand what that might mean to lend on the construction side?
Sure. So many people are aware of AIV, as is value, or ARV, after repaired value.
That's right.
And typically in fix and flip loans, your loan is structured with both of those kind of as a limiter, right? Up to X% of as is value, or up to Y% of ARV, up to 70% of ARV, or 75% of ARV, or so forth. The construction lending world is a little bit different, and typically loans are structured in the construction lending world in terms of loan to cost. And what does that mean? Okay, that means what costs are involved in bringing the project from buy all the way through to the point where it's going to be marketed. So if you're buying the property, give you an example. I'm giving you a kind of California example, so the prices will be a little high. Yeah, so you're buying a property for $500,000, right? And you're going to build. It's in a high-priced neighborhood in Los Angeles, and you're going to spend $1.5 million on construction. So now you've got a $500,000 buy and a $1.5 million construction. So now you're up to $2 million total in costs so far.
And Steve, let me stop you for a second. Is that from the ground up, or are we talking like a gut job? I just want to make sure we're on the same page.
From the ground up.
Okay.
It could be a house. You're buying something for $500,000 with a house that you have to demolish, and that'll be part of your construction costs. Or you're buying land that you're going to build from the ground up. Either way.
Fantastic. That's great. Okay.
So now you're at $2 million, right? Then you're going to have your points, your fees, your third-party title, escrow fees. Let's just say, just off the top of your head, that's another $50,000, right? Mm-hmm. And then typically with construction loans, you build in a pool of money to make your payments along the way. So you might build in, maybe for this loan, another $250,000 worth of payments. So now you're up to $2.3 million total in costs. All right, you with me, Ruben?
I'm with you. I'm with you.
Okay.
I'm taking notes. I'm in the lab. I'm taking notes.
Okay, good. So now typically on construction lending, you're going to lend a certain percentage of that $2.3 million, right? Normal might be 80% of that. So 80% of the $2.3 million is going to be somewhere around 1.84 million, if I'm doing my numbers in my head correctly.
Yep.
Something like that. And then the borrower would need to come in with the rest, around $460,000. And that's obviously making sure the deal makes sense, making sure. So in this particular case, if you're putting $2.3 million, you're going to want your property to be worth maybe $3.5 or $4 million on the end run, on the end of the game, right?
Yeah.
So there's
when it
plenty
hits
of
the
meat
market.
on the bone.
Yeah. Okay.
Right. So so in that particular case, you're maybe at 67 to 70% loan to ARV.
That's right.
But in the construction world, you typically loan to cost is all your costs in the beginning, which does include all the third-party costs on the buy side, and usually does include somewhere around 6 to 9 months worth of interest payments, maybe more. And that's how it's structured. Does that make sense?
Wow, that's fascinating. Yes, and I guess my biggest question I have after this is, I guess what we're used to on the, whether it's multifamily or whether even if it's a residential home, is we're used to the asset being collateral. In that case, when you're building from the ground up, is the upfront money put into some type of account, escrow? Like, how does that work? I'm just out of curiosity. Top of mind.
So yeah. For example, in this particular case, the $1.5 million for the construction, right?
Yeah.
So typically the way that works is the $1.5 million is set aside on a line of credit. So that means that you, as the client, you're not paying interest on that money until you actually draw on it, but it's available for you to draw on. So as you progress on the property, you do a certain amount of work, then you get reimbursed for that work that you've done, and then your loan will slowly increase up to the full loan amount once you've fully built out the property.
Beautiful. That's a way to put it together. I really appreciate that, because that's a really good. And obviously, you have the experts on your team. If you were to work at that, this is a very high level in the lab overview, and I'm glad you cleared that up for us, because I that was one of the questions that I had. Okay, fascinating. So real quick, in the lab, we like to get a little granular, and before we get to the fire round questions, what we'd love to know. We hear points, terms, rates and points. Tell us a little bit about, on your team or from how you operate, if I come to you with a deal, what's going to determine, what my points are up front? Is it experience? Is it the deal? Is it, would you like to give a little insight of what a lender is thinking, when they're sitting at the table? And considering, obviously, we know that you're obviously Anchor Loans is on our side, but I want to know a little bit more of how you guys operate as a company when it comes to that.
Sure. So the way we think about things is we have 4 different tiers for our clients: A, B, C, D. We call them elite, professional, success, and entry. Nice. All right. So the entry level, basically tier D, is someone who's only done a few deals, has a certain amount of credit, has a certain amount of cash. All the way up to the elite level, A, which would mean typically they've done 50 or more deals in their lifetime. They have a certain amount of net worth in cash, a good FICO score, et cetera. So we have 5 or 6 different parameters that we throw into the mix. Our software lets them know what tier you're in. And basically your tier then dictates what type of rate and terms we can offer to you. And if you got a better deal, if you're in a tier, let's say you're an elite borrower, but happen to be giving us a really good tier, a good deal in that we're not having to leverage all the way up to, say, 75%. It's a 65% loan to after improved value, or a 55%. Then we give you the best rate we can, right? So our points vary anywhere from 0.5 point and 7.5% interest. This is for a year. Yep. Up to, like, an entry level borrower will be typically somewhere about 2.5 to 3 points to 12% interest. Yep. And in between that, depending upon if you're a B or C borrower. So it's not fixed in the sense that You give me 5 things. I look up on a grid and I match you, and this is your points. There's a little bit of an art to it. Yeah, there's a range, and then and if you've been a previous borrower with us and you've always made your payments on time, that's in your favor.
That's excellent. And again, the reason why I asked that was a great explanation, number one. And number two, and the reason we asked that, the only way, I always say the easiest way to do business with people is to explain how it works. And I think you've done a fantastic job today. So thank you for that, Steve. A lot of great insights here. Wearing your lab coat. You are you're still a doctor in this lab, right?
Technically, I am. That's right. There we go.
Dr. Pollack, he's here. He's dropping the bombs. I love it. So, all right, fantastic. So, quick, I want to hit these points real quick. Mythbuster, what do you think is the biggest misconception that investors have when working with lenders? Is there something that comes to mind where it's like this misunderstanding that we have with lenders? Maybe this point that we just talked about was one of them, but any other insights?
I think the biggest myth is that a client believes that they can't just be open and honest and communicate with their lender. From our standpoint, if you run into a cash crunch and you're late on your payments and you call us up and you tell us, more power to you, because we understand that that's a normal situation. We're going to work with you. If you go radio silent and don't communicate with us, we don't know what's going on. I mean, that's a problem. So one of the biggest myths is that it's in the client's best interest to be quiet and not tell us your problem, when it's 180 degrees the opposite. You tell us the problem, we'll figure out what the solution is. We don't want your property. We want you to be successful. So let us help you with the solution. Yeah.
Well said. That's exactly right. Excellent. Well, what do you think is the biggest mistakes investors make in real estate? I know you touched a little bit earlier on over evaluating, and that's when you step in, but what are some things that you're seeing that are common mistakes that you're like, man?
The most common mistake, especially for your entry, your beginning kind of level, is getting too psychologically married to the asset. Whether it's my first deal, okay, I know that I told myself I'm going to this auction, I'm going to buy this property, I'm not going to spend more than $87,000, and they go home saying, I wonder how I ended up spending $102,000, because they wanted to get that deal so bad.
Numbers.
You got to be disciplined, patient, and not psychologically married to, like, it has to be today, I got to get the deal today. Same thing on the back end when you sell the property. The market will tell you what your property is worth. Don't be psychologically married to, like, I did such a great job in putting in those cabinets and painting that bathroom and thinking that it's worth more than the market tells you what it's worth. The market will tell you what it's worth. It's a business. Think of it as a business. Deal with it like a business.
Excellent. And speaking of business, that's a great segue, because obviously you come with a lot of various backgrounds where you've started businesses yourself. You sold some. You're a doctor. You're a poker player. I love that, because again, it just shows your core values coming out. And I'd love to hear, what is the best advice that you've ever received that you would share with the community in all of your endeavors that you've had?
So the best advice I ever received is just believe in yourself. Believe in yourself. And does that mean that you're going to be perfect and make perfect decisions? Of course not. You're going to make mistakes, but that's how you learn, right? Believe in yourself. Know that when you make a mistake and you fall down, you get up, you learn from it, and you grow. That's it. You got to believe in yourself. Too many people say they believe in themselves, and then they're scared to make that first step. They're scared to dip their toe in the water. They feel like they have to analyze things for a whole year before they get started on really what's their passion and what's their life stream. Yeah. You believe in yourself, what's the worst that can happen? You go back to your job that you were doing beforehand anyway. So
no, I love that, Steve, because I'm a huge believer of I think you're probably a perfect example for it, Steve, that, once you get started and you just take that action, there's things along the way that you'll stumble upon or that you'll discover that you may not have realized had you not taken the action. And I think you can probably attest to that, because I think if someone asked you, did you think that you'd be, the CEO of Frankl Loans, considering your background? Well, probably not, but had you not gotten started in real estate, then you wouldn't have known that maybe there was an opportunity in a marketplace. So I'm good for you for echoing that message. Excellent. So I like to get, again, these are the rapid fire questions. You're obviously a very interesting individual who stepped in the lab today, who we have the luxury of having. Obviously, your operation is just as great. I like to ask these questions to understand who is behind who is the poker player and the Minecrafter behind all that goes on. So really quick, tell us, what is your favorite book, Steve?
My favorite book
Yeah.
is Man's Search for Meaning, Viktor Frankl.
Wow, never heard of that.
So it is written by a Nazi death camp survivor of his time in the Nazi death camps, and how he grew psychologically and internally in terms of accepting human beings for their faults by going through that obviously very traumatic situation.
Oh, okay, that's great. I'll definitely make sure I put that in the show notes as always. What is the best habit that serves you every day, Steve?
My best habit.
Yeah.
So I'm very organized and very disciplined. I do things I come into work a certain amount of time. I look at emails and then I shut them down a certain amount of time.
Good for you.
I do some other activities. I try to be as organized and use my time as efficiently as I can. I think time management is a misunderstood and super important part.
Mm-hmm.
That's something that all of us have the same amount of, and many of us lose it and use it unwisely. So I try to manage my time as best as possible.
It's a great segue. Maybe you want to talk about what's the best tool that helps you excel throughout your day. Do you have something that manages your time well, or is it a calendar? Is it notes? What is it?
No, it's the TikTok going off inside my head, and I don't mean the social media TikTok. I just mean the clock.
You know what? That's important that you say that, because who knows these days with our lovely millennials. But okay, so interesting. You're like the third person now who said this, and I can't stress this enough. In the lab, like literally all we talk about is personal development first, and that projects into all your endeavors, and whether you're a real estate investor or syndicator or whatever it is you're being. And so when you say your mind, I mean, it just goes back to the core again. That's fascinating. Okay, so best tool, you covered that. So I want to hear a little bit. I always ask this question. Would you rather own a 300 unit apartment or 3 apartment buildings of 100 units?
3 100 units.
Why is that?
There's a little bit more diversification there. You are able to, if needed, if they're not all side by side, you're able to maybe service different client models. And so where you might have a higher vacancy rate across 300 unit buildings, I suspect with 3 different 100 unit buildings, you'd be able to get that vacancy rate up somewhat.
Yeah.
You might be able to offer, free first month rent in one, but not in the other, where you can't do that if you only have one building. So I prefer the diversity on 3. I know it's a little bit more work. You could have to have 3 property managers and 3 different sets of various things to do that, but I think the offset of the diversity makes up for that.
Good for you. Always hear different answers. Self-manage or outsource?
For the 3 buildings you're talking about?
Yeah.
Then I'm going to outsource. That's a lot of work.
It is. It is. If you had one superpower in your business, what would it be?
Superpower in business. Yeah. Whatever superpower I want to make.
Whatever. Pick one. It's dangerous now, Steve. Be careful.
Yeah. Besides growing my hair.
Stop. You don't stop it, Steve.
I guess the ability to go back in time.
Really? I haven't heard that one. That's interesting. Would you say you have any regrets?
I have no regrets. I wouldn't change anything. I don't live that way. I always live looking forward and never look to the sense that anything has happened in the past. I try to learn from it. I never regret doing it. I never regret making a mistake or making a decision that led to a mistake that I could have done better. I don't think that way. However, I know that, as the years roll by, again, time being a limited resource, I sort of like to capture more of that. I would give up everything I am worth today to go back and be 25 years old again with nothing.
It is youth. I always say that, age is definitely, the youth is rich. That's for sure. That's fascinating. Good for you.
You know what they say? They say the youth is wasted on the young.
You're making me feel terrible. Jeez. All right. So if you could describe a successful investor in one word, Steve, which word would you pick?
Discipline.
I really like that. It says a lot about you there, Steve. I love it. I love it. All right. So you're an opportunist. This is the last segment of the show. I like, it's called Bridging the Gap. I'm all about solving problems. I think a lot of us are, and I'm always interested to hearing what, you know, folks like you who come in, who are practitioners, if you could make one thing easier in your day-to-day in your industry, what do you think that is, just out of hindsight, just something that's just anything
Uh,
that's giving you friction? I'm curious. I'm just to see if there's anything out there that you feel could be
that's a good question. I don't think I've
optimized
ever been asked that question before.
in
So it's making me think, is there something that could create less friction?
your day-to-day operations.
Um, I can't think of anything.
Oh,
I can think of lots of little things, but they're all
yeah.
insignificant.
Oh, interesting.
No, I can't think of anything.
Okay, then I stumped you. I'm happy.
You stumped me. Okay.
I love it. No, that's cool. No, I
I
always
blew
like
it
to
on
ask that.
Final Jeopardy. I don't
Oh,
know.
stop. No. There's no right or wrong. I just like hearing what's
Okay.
going on out there in these in the day-to-day. But as far as you work with a lot of this is the market segment here. It's you work with a lot of investors. Are you seeing a flow of volume going to a specific place? Again, kind of like we like to have some insights in the lab. Are you seeing some opportunities that folks might not be thinking of, like a particular area in the nation, since you guys are nationwide? When you look at your numbers of where you're getting the most loans, is that something you'd be able to share with us?
Sure. We're still primarily a California-based organization, and so
Mm-hmm.
by state, California is the largest state of our lending operations.
Oh, wow.
But it has the most challenging markets because it's the most competitive here.
Mm-hmm.
It requires the most sophistication in knowing what you're doing, whether it's ground up construction, value add type of deals or whatnot, or investors having to segue into other niches in the real estate market that maybe they're not so familiar with, moving from owning 2 to 4s to maybe owning multifamilies and so forth. In regards to geography, the Southeast is pretty hot. So
That's right.
Georgia, South Carolina, North Carolina, even Florida are lots of opportunity there right now. The other thing that I would say that we're seeing kind of as a nationwide trend, and that probably will come as no surprise to you, is that there's been a significant shift from buying, fixing, and selling into buying, fixing, and holding for rent.
Yes.
So there's a lot of that's going on now because it makes sense. The rental economy is more stable. It makes sense in terms of buy prices and what you can realize for your rents. So doing a little bit of both, in my mind, someone who as an investor is turning some of their properties to be able to put food on the table and keep their operation going, and then holding some of their properties to build long-term wealth makes perfect sense to me.
That's wonderful. Listen, Steve, this was fantastic. I mean, you gave a lot of value to I think my community is going to love this. And most importantly, one of the keyest words that we use here in the lab in my community is, I always talk about partnerships, strategic partnerships, and I couldn't think of a better person and company to, either it's someone who's currently looking to grow their portfolio or someone who's starting out. I'm sure you can offer so much value. And if that's the case, Steve, where can individuals and investors and anybody find a little bit more about you and your company?
So website, it's pretty simple to remember, anchorloans.com, like a boat anchor, ANCHOR loans.com. We have a portal on the website where you can enter information, get a quote. We have a
Nice.
chat feature there if you want to just chat with somebody. Our phone numbers are there.
Nice.
My email address is there if you wanted to email me. I'm available, make myself available. I'm not sitting in some ivory tower somewhere. I'm here. I'm an operator.
We appreciate that.
Right. You can follow me on Instagram, Steve Pollack CEO, Twitter, Steve Pollack CEO. I'm on Facebook as well. Pretty easy. If you look for us, you'll find us.
Excellent. And I call myself the super connector in the community. So if there's anybody that I come across within my network and I should think, hey, maybe this should be a good person with Steve, who would that person be that I could make an introduction to, and or what type of person would that person be?
Somebody who you're going to introduce to us.
Yeah.
Is that
So
what
it
you
could be
said?
like if I meet someone and I'm keeping you top of mind, and I say, you know what, Steven, you should connect. I'll make an introduction right now. Who would that person be, or what kind of person would that be?
Anybody in the real estate industry that is looking to gain knowledge, that wants to make a connection.
Yep.
I love being on podcasts and shows like yours. You're running an
Oh,
awesome show here. I love
thank you.
speaking, and part of my core and my being, and that is to help educate people.
Yep.
I didn't mention, but while the time I was practicing optometry, I was also a clinical professor at Berkeley in the optometry school there, teaching
Look at
the
that.
residents. And so I love teaching. I love giving out information, help people understand the world around them better, make better decisions, whether that flows into any type of business opportunity or not. That's not what I'm after. If it happens, it happens, but it's not, there's not the expectation there. So when you say, who could you introduce me to? Somebody that either has questions that I can help answer, or somebody that has a show like yours, or similar to yours, that would want me on to answer a different set of questions.
Oh,
Hopefully not stump me like you did.
oh, no, that's only when you come into the laboratory. That's what it is. But it's a
Yeah,
learning
it's good.
environment, and it was fantastic to have you on the show. The last question I ask is, what question do you wish I would have asked you that I may not have asked? It gives you an opportunity to share anything. Did I miss anything there, Steve? Anything you wish that would have asked you that I missed?
Let me think. Can't think of anything. You asked a very, very broad range of questions. You covered a lot of different topics.
You did.
I think it gave a good opportunity for your community to get a taste of lots of different areas, especially in the construction area. You had a
That's
good
right.
interest in that. So can't think of anything off the top of my head, but if somebody out there who's listening to your show thinks of a question and wants to shoot me an email, or shoot you an email, I'm sure you know how to reach me, and be happy to answer it at that point in time.
Definitely. And just like that, guys, thank you so much. And we are out.